Hey everybody, this is Ryan Mallory with the stock market update number 17. Not sure I'm ready to stick crash back into the title yet. We did have a little bit of a crashity crash on Thursday. We saw the S&P 500 drop 188 points. Huge move. In fact, it was more than 5%. And since 1952, there's only been 29 times where the stock market has actually dropped by more than 5% in a single day. We've seen more than 5 of those this year alone, and this was the biggest drop since like March 16th. So this was a big deal of what we saw on Thursday. It has big ramifications on the stock market, a lot of technical damage. So we're going to look at that. We're going to see what it means for individual stocks, and we're also going to talk about the indices as a whole and where this market's going forward, because what we saw this past week may have been representative of a major shift in market sentiment. Now the S&P 500, first chart we're going to tackle today, saw a huge bearish wedge chart pattern confirmed. Now if you remember some of these past videos I've done, we've seen other bearish wedges. Remember this bearish wedge pattern? Yeah, it confirmed to the downside, but it didn't actually go that far down. So are we going to see a repeat of that, where the big drop on the S&P 500 this past week only gets bought up this coming week? This is a major development that we need to be very aware of. I don't think it bodes well for the market. Go back to late February. We saw a 2-day sell-off followed by a massive gap lower. What did we get this week? A 2-day sell-off followed by a massive gap lower. The difference? We rebounded a little bit on Friday. We never rebounded on the 4th day. We just kept on selling for multiple days that followed. However, it doesn't have to follow history the same. What I'm trying to show is that there's some of the same kind of weakness that we saw back in February all of a sudden emerging in the stock market today. Eerily similar. Now pull up your SPY chart here, because what we have here is a bearish island reversal pattern. These can oftentimes mark the tops of significant moves. You also have them to the downside, and we'll show you an example of that here real quick too. But here you have about a cluster of 4 days following a major gap up, and then you had a similar gap lower, which is what we got on Thursday. And what tends to happen here is you get more downside in the days that follows. Now we had a bullish island reversal pattern that worked out really well for the bulls, going all the way back to early April. Instead of 4 days, it was 3 days. But here you have a gap down, and then you have a little bit of consolidation, and then an equal gap higher. And all it did from there on after is just rally the market to insane levels. So the reason why I think you have to be respectful of this is because the same candle pattern that created a bottom is now forming a top. That's something that you have to be very concerned with. Not a lot of people are talking about it. I am, because I've seen these candle patterns play out very well and very accurately. Doesn't mean it's a guarantee for the future, but you have to pay close attention to it, because it is signifying there is a lot more downside to this market to come. Now, how about the moving averages? We broke the 5, we broke the 10, we broke the 20, and we broke the 200-day moving averages this week on the daily chart. Now, we reclaimed the 200 on Friday. That's a good sign for the bulls. It's trying to use that as support. 3,000 is also a very key support level for the S&P 500, or 300 on the SPY. Right now, if you're a retail trader, you got to be careful, because there's a lot of games being played here. You got companies like Hertz, Chesapeake Energy, American Airlines, Boeing. They're getting bid up in the pre-market by institutions so that the Robinhood bros will come in there at the market open, buy them up, send them up way higher. Institutions liquidate their positions to the Robinhood bros, oftentimes marking a intraday high or an intraday reversal and sending the stock right back down and fading it. Don't do that. Don't chase after these crappy stocks. I'll get to those more later here, but please don't get into them. Don't fall prey to those kinds of games. The other thing that we saw on Thursday that was extremely important was the volume. The volume was incredibly high. Friday, yes, we finished still like 1% higher on the S&P 500. Was that a good sign? No, because guess what? We faded most of the day. It wasn't until the last couple hours of trading that we actually saw a pop in the market to get it back into positive territory. We were like 88, 90 points higher in the early trading, only to see it fade almost from the very beginning of the cash session, sends it all the way back down into the red, and then we bounced a little bit to recover some of those losses. To me, that is not a victory for the bulls. That was not a good bounce back day. The candle's not good. It closed way lower than where it opened up at. That is not a sign of strength. That's a sign of weakness. That means that people are still using market bounces to get out of some of their long positions and to short it. Now for me, I actually shorted the market on Friday. I got into an SDS position. I closed about a third of it. We'll see how it does next week. If the market decides it wants to rally, it'll take me out of my position, but at least I secured some of the profits along the way. Now how's the weekly chart looking? Weekly chart looks bearish. You have a bearish engulfing candle pattern yesterday where price action actually engulfed the entire previous candle body from the previous day. Not a good sign. That's bearish. You also have the bearish wedge that I talked about before. It's confirmed to the downside. Not as strong of a move on the weekly chart. Now in previous videos I talked about the 50-week moving average. Yes, you need to be concerned about that here too, because it is showing some support here so far. It dips below the 50-week moving average intra-weekly, but it managed to close the week above it. So going into next week, can the market hold that 50-week moving average? You can see in history's past that we have constantly bounced off of that 50-week moving average. So if the market can't hold that level going into next week, there's a good sign that we're going to retest those lows or get very close to it from March 23rd. Also, check out this huge support level that was broken on the SPY from last week. This support level goes all the way back to 2018, early 2018. It didn't just break the level, it sliced through it like a knife through hot butter. Also, on the weekly chart, volume has picked up considerably. This is the biggest week of selling since the original sell-off ended. So huge uptick in volume. And guys, look at the gaps on this chart. There's tons of gaps to fill, going all the way back to almost the March lows. Historically, these gaps get filled. Now on to the monthly. We're looking at a very topish kind of candle pattern. June has a shooting star candle pattern, not a good candle pattern at all. It's very bearish. And if this weakness holds, it will mark the 4th time in the last 6 months that the market finished lower. But here's the big key, and this is what should give us all some pause. It's a very similar candle pattern that we saw back in January, where the market shoots up and then gives back all those gains, except it's much more exaggerated, it's much more bigger, it's much more bearish. Now how about some of the other indices? The one that's holding up best is the NASDAQ. The weakest is the Russell, and I'll get to that in a second. NASDAQ still holding on to the 20-day moving average. That's impressive. However, the reason why that's happening is because when the market sells off, there's this mentality to flee to the tech sector, especially with any kind of coronavirus headlines. That's where the money's going. However, what we saw on Thursday was something that we haven't seen since this whole sell-off began, and that was selling not only in the S&P 500, but we also saw it in the FANG stocks, which represents a huge part of the S&P 500 and an even bigger portion of the NASDAQ 100. So then we saw the Russell sell-off, and then we saw the energy and the financials. The reason why I bring up all these sectors and these particular indices is because these don't sell off together that often since the whole recovery began. When there was a market sell-off, either the Russell would still manage to rally or the NASDAQ would still manage to rally. But then when you start seeing a sell-off where both of them are selling back off and none of them are rallying, that's a good sign. In fact, early on the NASDAQ did try to rally and then it got quickly sold off. That's a good sign for the bears if you're looking for further downside. It's a bad sign for the bulls if you're looking for more upside. So going forward, watch to see during sell-offs, is the NASDAQ selling off? Is the Russell selling off? And then look at the individual sectors. Is tech, financials, and energy all selling off together as well? If it is, it's a very secular downtrend that's unfolding. Like I said, the Russell took the biggest hit on the week. And on IWM, it's going to have a lot of resistance to deal with at the 145 level. You need to watch that. It broke right back below it. That's a key level to watch going forward, as is the 50 and the 200-day weekly average that are converging on top of each other. That's going to add another layer of resistance at that same exact level. Now, I haven't talked about the VIX much lately in some of my recent videos because it's just been pulling back steadily every single day almost. But what happened on Thursday? Huge spike, practically a 50% pop in the VIX index. Yes, it did give some of it up on Friday. That's not surprising considering the rally that we saw into the close. However, this is a big candle here, guys. This is something that you should be very, very troubled by, because typically when we get these kind of candles, yeah, we'll get a sell-off the following day, kind of like what we saw back in early March on March 2nd, but it still proceeded to keep marching higher in the days and weeks that followed, all the way back up to 90. Now, do I think we'll get back to 90? Probably not, but there's a good chance of it, especially if we start shutting down states again because of the COVID spiking. But look at it. This is a straight up breakout right here for the VIX. Now, how it performs on Monday and Tuesday of next week is going to go a long ways whether or not it can hold these gains going forward. Now, look at the VIX on the weekly chart. Even crazier. Man, this is a solid breakout of a bull flag pattern, basically. It's a little bit of a steep bull flag pattern, but nonetheless, it is a breakout of that pattern, and it looks like it wants to get back up into the 50s, 60s here very soon. Now, let's talk about some quality companies here. We're going to talk about Facebook, Amazon, Apple, Netflix, Google, and Microsoft here. I'm not going to spend a ton of time on them, but I'm going to give you enough to give you an idea of what to look for going into next week. First off, Amazon had a breakout early on this week, but it gave it back Thursday and Friday here. You can see as well, Amazon didn't participate in the market rally on Friday. In fact, it still continued to pull back some. So a definite sign that there is some profit taking. However, there is some support underneath in the short term that is trying to hold on to. So if the market does get bullish next week, this might be a good bounce play to take advantage of. Facebook, I'm not liking this one at all. In fact, I'm looking to short this sucker if this double top pattern confirms here. What it needs to do is break the short-term support level, and then once that does, that's where I want to get short. Watch it fill some gaps. It has plenty of room to the downside, possibly as low as 200, so there could be a 10 to 15% move that could be made in this stock. But it's going to need the market to participate a little bit. It's going to need the market to give it a little bit of a push to the downside. It's not going to do it on its own if the market just wants to go right back up again. Apple, way overextended, very overspot. I don't necessarily like it at these levels. I think if you can get it to pull back maybe to like the 310 to 315 area, that might be a place for it. You have huge long-term support that goes all the way back to earlier this year that if it can hold, that might be a place too to bounce if you're wanting to be aggressive on this trade. Again, I think Apple becomes much better if you can get it on a big discount. As for Netflix, there's little to get me excited here. I think this is probably more bearish than it is bullish at this point. For now, it's still trading in a sideways channel, but you have the possibility of a head and shoulders pattern forming here. If that confirms, it needs to break the neckline, and then you might have a move that goes maybe into the 350s. That's under a notable market correction that takes everything down with it. It's kind of like what we saw on Thursday, where 40-1 to the downside in terms of declining issues to advancing issues. Microsoft is very similar to the Amazon chart here. You have a huge support level. It's pulled back to it. It's trying to hold it, trying to hold the 20-day moving average. This is a possible bounce area for Amazon to shoot back up to 200. As for Alphabet or Google, whatever you want to call it, it's sideways consolidation, again, kind of like Netflix, but it doesn't have any real notable bearish pattern form it. It's just kind of like a sideways malaise going all the way back to early May. I don't really see an edge in this. If anything, I might say there's more of a hint of it wanting to go back down some. I just don't see a huge edge at this point in Google. Now let's talk about some of the trash stocks out there, because you got a lot of Robinhood bros out there. They're bidding it up. You can go to robintrack.net, I think is what it's called. And you can actually see what these people are trading every day. It's crazy. First, you got Hertz. I tried to do technical analysis on this. Maybe you got like a declining channel that's starting. You could call that a bull flag. I don't think a bull flag is formed with more than a 50% range of its price over the course of a week. No, this thing's trashed. Don't get into it. Huge headline risk. Yes, I know that some of you are going to be tempted to do it, and maybe you've even made some money by luck because you don't control the headlines that are hitting this thing every day. You don't know if they're going to issue more shares like they did. This is trash. Don't jump into this thing. You're better off going to Las Vegas and sticking your money on red or black. I had a lot of people try to jump on me about AAL this past week. They're like, hey, Ryan, glad I didn't listen to you on one of your videos because this thing shot up. Who cares? Who cares if it shot up? Because you're just paying attention to how much money you think you can make out of a stock. You're not looking at the risk that comes along with it. If you got in at 23, guess what? This thing's trading back down to 16, as low as 14. You're playing with like 30-40% downside on this stock. The risk reward's horrible. Maybe it does keep going up, and I've told you that before. I wouldn't be surprised if it goes back up to 25. However, you can't control the risk on this. You can't use a good stop loss. Look at the gaps all over it. Move on to something better, because this is just straight up hopium. Another one, CHK. You think you can control the risk in this? No, look at this thing. It goes up to $76, $77 when it was just trading at like $11, $12 before. It's had like a 1 to 200 reverse split. Don't get into this stuff, guys. Oh, but it was up 12% on Friday. Who cares? Thing could be down 50% on Monday or up 50%. What do you know? Is it worth risking 50% of your capital on the trade to make 50%? No, that's a 1-to-1 risk reward. That's trash. Don't do that. And Boeing. Guys, this thing's headline risk all over the place. You don't know what the next headline's going to be. There's some support at 187, but this thing gaps through anything it wants to. Again, this thing could go up to 300. Can you use good stop losses? Is there places that you can put the stop loss at that you're not risking massive gaps below it? You can't. Huge headline risk, guys. How about NCLH, Norwegian Cruise Lines? Maybe there's support at the 17 level, but again, lots of downside risk. If it holds 17, yeah, maybe there's a chance it hits 30 pretty soon. But the volatility in these plays are incredible. Now you're coming back at me and you're saying, well, I made 100%. Well, what did you make it with? Because if you're using any like large sums of money, you can't trade this stuff. If you're trading a couple $100, yeah, I could trade that all day long. That's not a big deal. From a dollar standpoint, the risk isn't there. You're risking a chicken bowl to go at Chipotle's for that amount. But if you're going to be risking tens of thousands of dollars or even more, this isn't a stock that you want to play. You don't want to play Boeing. You don't want to play NCLH, AAL, Hertz, Chesapeake Energy. They're trash. How about Tesla? No, I'm not calling this a trashy stock. I think it's a phenomenal company. I don't know what the long-term prospects will eventually be for this company, but they got something going here, man. This thing went over $1,000. It's pulled back, but here, if it gets into the lower 800s, it could see a bounce because there's a key support level there going back to February of this year. If that support level can hold, there's a good chance you're going to see a bounce back into the thousands again. So maybe there's like a 20 to 25% return on that kind of a trade. In the end, I tell you guys this every time. It's about managing risk. People are like, oh, I can make 50% off of that. Who cares? But do you have to risk 50%? Do you have to risk 75%? If that's the case, it's not worth it. It's really not even worth it if you can make 50% but risk 25%, because guess what? It's hard to get a stock to move 50% in a short order, but it's not hard when the stock is that volatile for it to drop 25%, stop you out, and for it to go right back up again. And in the end, we're risk managers, not getting caught up in all the riches of the stock market. You're managing risk. And until you get that concept down, it's gonna be very difficult for you to succeed long-term in the stock market. I got people emailing me saying, I'm an expert now in the stock market. You're not crap. I'm not crap either, guys. I react to the stock market. I respond to what the stock market's doing, but I never think that I have some kind of like moral superiority over the stock market, because I don't. At any given time, the stock market can wipe anybody out. That's why we have to manage risk, because if you're not managing risk, you're not really trading. I appreciate you guys listening. I'd ask that you like and subscribe. I'll continue to put these videos out there, about 2 a week. If you have any questions, feel free to leave it down in the comment section. I try to get to as many of the comments that I possibly can. I read them all, and I'm usually responding to a couple hundred of them every week. So keep them coming. Let me know what you think. If you like what I'm saying, put something down there to let me know what you think. If you think I'm wrong, put the clown emoji on there. I don't care. But tell me what you think. Tell me if you think I'm right. Tell me if you think I'm wrong. We'll hash it out in the comments below. Take care and God bless.